From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the latest payrolls report is coming in hotter than expected, and it's sending Treasury yields spiking as traders adjust their rate cut bets. And Fed swaps are shifting the first full cut to September. But we first begin with the big issue, mixed signals in the data.
Overall, a very strong report.
Payrolls, non-farm payrolls, really critical here.
The labor market continues to chug along.
Right now, jobs take on a much bigger proportion of the thinking at the Fed than the inflation numbers.
They're so focused now on the labor market.
I do think that the labor market is carrying more weight.
The labor market is still rock solid.
Very strong.
Very resilient.
Showing that there's resiliency.
Every measure of the labor market has shown incredible strength over the last several months.
The labor market's been really underpinning the consumer, and the consumer's really been carrying this entire economy.
That has driven that, stickiness in the inflation that the Fed continues to struggle with.
The economy, both on the labor market side and inflation, is going to moderate in the coming months.
We really have to look for that CPI print.
Everything is going to depend on the data.
Let's look at the two-year yield and how it reacted to that jobs data here, because you are seeing a move higher in yields on Friday, about 8 basis points higher, back above that 470 level, which is exactly where we started the week. And remember, these are the highest levels we've really seen since back in November here. And you did see quite a bit of a bid in the bond market this week alone. Tons of volatility, more than a 15 basis point move from peak to trough when you look at it, and spikes really happening when you kept on seeing that strong economic data back in the ISM data and the ADP data. If we flip up the board here and see what it means here in terms of the Fed swaps, pushing out that rate cut odds that you're seeing here, both on the back of that strong data as well as on the back of a lot of Federal Reserve speakers here, you do see September being much more likely now than you do see even in the summer. Now, that first rate cut is really being factored in September, and that odd of a rate cut in June or July has really fallen quite meaningfully. And remember, there was a time where we saw more than 5-6 cuts being priced into those swaps earlier this year. And we've heard a lot of Fed speak this week just about rates. After that jobs report, Dallas Fed President Lori Logan said it's too soon to consider cutting. And just yesterday, Minneapolis Fed President Neil Kashkari floated the possibility of no rate cuts at all.
If we continue to see strong job growth, if we continue to see strong consumer spending and strong GDP growth, then that raises a question in my mind. Well, why would we cut rates?
Joining us now is Al-Hussainy of Columbia Threadneedle and Karissa McDonough of Community Bank. Karissa, if you think about what we've seen over the last week alone, how has it changed your thinking about that measure of rate cut that we'll see this year?
Thanks so much for having me on. We really believe that the path of cuts has been pushed forward or pushed out later in the summer to the fall. But we take some reassurance from Powell's comments earlier in the week. Of course, he's talking about data dependency, but he also stood behind those 3 cuts in the dot plot. So that is something that he reiterated. I agree with some of the earlier footage you had shown with the labor market is really becoming important, but there are other factors that the Fed is considering too in terms of just broader market liquidity and repo facilities and commercial real estate. So while some of these statistics look good, there are some other things that they are still thinking about which would support the idea of cuts here at some point.
Now, it's certainly market moving what we saw in the jobs data, Ed, but what do you think about what it means in perspective of the data we'll see just next week with inflation, given we've already seen some hints of heat in the ADP data and jobs when it comes to wages?
Yeah, absolutely. And I think the question for the Fed is, look, we're seeing a cyclical pickup in the economy. We're shifting growth expectations higher. The labor market continues to do well. The key question is, does it translate into upward momentum and inflation? If that piece falls into place, then the argument for rate cuts continues to weaken. However, the learning from last year is that high growth, a healthy labor market can coexist with falling inflation, and we're going to be putting that to the test in the next couple of months.
Now, when you look at these moves in the market right now, Ed, do you find these as buying opportunities, or do you wait a minute before you step in further in these dips?
Yeah, look, I think you dollar cost average into something like this. I think you have to be slow, just given the momentum in the underlying data and in the fact that we started the year with very aggressive expectations for rate cuts. It made sense for them to come out. But where we are today, having this conversation of 2 to 3 cuts a year seems quite reasonable to me. And if you look further out on the curve, the real yields today, the all-in yields, I think are quite attractive. And so I think it is overall a pretty decent buying opportunity.
Now, at this point, Karissa, what do you think is kind of the biggest driver of the volatility that we're seeing in the market? There are so many knee-jerk reactions to the economic data, and frankly, also now knee-jerk reactions to the Fed speakers that you see headlines crossing the tape on how they feel about the rate cuts that we may see this year. What are you reacting to the most?
Yeah, you're exactly right. There has the amount of swings and yields that we've been experiencing, that the fact that we've had something like a 3% loss in treasuries just to start April, those are kind of historic moves magnitude-wise. But again, I think it's just what you said. I think a lot of these, the marginal investors looking at every data point and trying to discern what is it that the Fed is going to eventually do and where will we eventually end up in terms of cuts for this year. But we remain steadfast that we still think it's appropriate for some degree of cuts to occur through the balance of the year. And back to the idea of what is attractive in this market, like duration and long treasuries remain very attractive. Real yields at this point are extremely attractive investment opportunities.
How do you feel about duration here, Ed? Do you feel that you're comfortable going out on the curve given how much volatility there's been?
Yeah, it really depends on what kind of investor you are. I think if you're an institutional investor in particular, you're looking at this environment as an opportunity to get into the duration space, whether you're doing it through investment grade credit or treasuries. If you are a retail investor, you're making a decision of, do I come out of cash? And that's kind of the hardest decision this year. It looks like the Fed's delaying the rate cutting cycle. Do you come out of cash or do you wait? And I think the answer on our end is emphatically yes. This is exactly the right time to extend your duration, maybe not all the way out, but 1 or 2 years, lock in those rates and allow the Fed to play out over the next 12 to 18 months.
Now, a question for both of you, starting with Karissa. How do you see the Treasury market as a safety trade at this point? I mean, with so much volatility, do you think that people are actually moving into the market at any degree with any uncertainties with the rest of the market? Is it a safe trade?
Absolutely, it's a safe trade. If you're talking about just a few basis point moves, we expect that we're near the end of kind of the peak in rates. You'd really have to see a significant move upwards in inflation. Again, we'll see the potential for that in the next couple of months, see if these strong economic numbers play out into influencing inflation. But yes, you're pretty much at the kind of top of the cycle in terms of real yields. And so this is absolutely the time to go ahead and invest. We also like the idea of high quality banks. We think investment grade, like spreads are quite tight, but banks still offer opportunity here. So even if you have some near-term volatility in rates, I think it's a very reasonable time to be kind of layering into duration trades.
Well, explain me this. Why buy a treasury if you can buy into other assets that are climbing faster? Gold, Bitcoin.
Yeah, absolutely. I mean, look, it's a question of to what extent do you think the valuation of those assets justifies what you expect to happen over the next 12 to 18 months. I think on the Treasury side, one powerful argument is the fact that as inflation's come down, it's come down from about 7 and change to about 3% today, the notion of the Fed put has come back onto the table. That Fed backstop wasn't with us in the last 2 years because they were so focused on inflation. Now the heat's out of the system and the Fed put becomes much more palatable. So in the event that there's a drawdown in risk, I think treasuries are going to perform much better than they would have had inflation been higher. And so that's, to me, kind of the most compelling argument at the moment.
And give me a scenario here in which you see the Fed not cut at all. How does that change your thinking, Ed?
Absolutely. I mean, look, if we look at today's data, one of the silver linings for the Fed from an inflation perspective is the fact that wage growth has not accelerated. We're seeing very robust numbers in terms of hiring, but wage growth continues to slow down. If wage growth picks up again, we're going to be in an environment where the Fed will really question their framework around inflation. And that's an environment in which potentially rate hikes come back online. At the moment, that's far from the base case.
Karissa, how do you feel about this idea of potentially reaccelerating inflation? How do you read the data next week, and what would concern you the most?
We actually don't. At this point, we would be really surprised to see a significant reacceleration in inflation. We are not kind of changing that kind of long duration type of strategy that we've been talking about. But yeah, it would have to be kind of a context shift here for the Fed to be talking about, well, forget cuts, we're going to start to look at hikes, and that would necessitate kind of a reassessment of the whole framework. But we're not in that camp. And I want to just reiterate something that I had said earlier, which is, we've been talking so much about strong labor data, strong economic data, but I don't want to lose sight of the fact that there are concerns on bank balance sheets. There's always a concern about potential liquidity squeezes becoming solvency issues. We saw that in the last financial crisis. That's definitely something that the Fed is looking at in its hip pocket. So even if all the data is wonderful on the surface, these are other considerations that the Fed has to have thoughts about as well.
And a lot of big banks coming out with their earnings just next week. We'll get a little more information on what this means for the lending sector here. Ed Al-Hussainy and Karissa McDonough, thank you so much for your time on a busy day of jobs data. Up next, though, we're going to talk about the auction block. U.S. high-grade bonds posting a record first quarter for issuance. We're going to discuss if credit can keep up this rapid pace. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we wrapped up a red-hot quarter. Over in Europe, market sales topped a new record of nearly 680 billion euros. The issuance exceeds the previous pandemic era record by 12%. Now let's move forward and look at sales this week in U.S. high grade. The total number of $24 billion topped estimates. Notable names included Enbridge, Alcoa, and GM Financial. And in high yield, companies like Herbalife and Rakuten drew attention, with the latter pricing a $2 billion junk bond. It boosted the size of the offering by 60% due to strong demand from investors. And sticking with credit, KKR's co-head of credit and markets, Chris Sheldon, says this year marks a golden age for credit allocation. This week, he wrote in a note that his view remains that the economy is slowing. Defaults will rise, but not skyrocket, and that dispersion will increase, creating opportunities for credit selection. Let's bring in Meghan Robson, head of U.S. credit strategy at BNP Paribas, and Matt Mish, head of credit strategy at UBS. Meghan, when you take a look at what KKR is saying, this idea of defaults rising, dispersion increasing, where do you start to parse your bets? Are there places that you start to take your foot off the pedal here, given this idea that potentially some more things can start to break?
Well, thank you for having me, first of all. So I think credit spreads have tightened a lot this year. We've priced in a lot of the good news. We still have a view of a credit soft landing. So we do think we're seeing all the signs of fundamental improvement that typically hint that credit is in a recovery stage of the cycle. To your point, though, we are seeing some increase in dispersion. So I think one interesting stat we've recently been focused on is, although credit spreads in high yield are at multi-year tights, you have seen the distress ratio, or the number of bonds over 1,000 basis points, start to rise a bit. So for us, we are overall constructive, but we are much more selective in the lower quality segment, so that CCC area, where we will have some companies able to perform well, while others will struggle.
Now, how do you think about this dynamic, Matt? If the idea here is that you have investors really flooding in to credit markets, searching for yield, do you think that there are some mistakes being made along the way, given that things could start to deteriorate?
Yeah, I mean, the flow picture has definitely been strong. I would say, though, we generally have the view that there are stronger and weaker balance sheets across corporates, across households, and across banks. And so one of the telltale signs we think for whether or not we're getting too late in the cycle, so to speak, is deterioration in weaker balance sheets. And I would say in general, on balance, the data has been more stable with multiple signs of green shoots. So, if you look at some of the default data that we have through the end of March, that looks like it's going to be indicating stability. If you look at private credit and that area in terms of default rates, we think they're actually easing or falling. And then obviously, I'd be remiss not to point out that, the data has been quite strong over the last several weeks, particularly this morning's employment report. And I think what we learned last year is certainly that higher funding costs are certainly pressure for corporate balance sheets, but the offset to that is strong growth and strong nominal earnings. And so in a lot of cases, we're looking for signs of quote unquote cracks or canaries in the coal mine. And on balance, we're just not that concerned at this point in the cycle.
Both of you seem pretty sanguine at this moment, and it begs the inverse question here. Meghan, do you find areas where you can double down with this kind of confidence?
So I think that the main bear risk or the tail risk that we're watching, which would cause a lot more problems for credit, is really a resurgence in inflation. And I think with the hotter jobs report today, there will be more focus on that. I think investors will focus more in the credit markets on CPI next week, for example. But for now, we're very confident that CPI is not resurging quite yet. So I think data this week that we've seen, ISM prices paid, for example, still very contained, the lowest in a few years. The Fed's preferred inflation metric, core PCE, also came in with consensus last week. So I think for us to really see more problems, you'd need to see that resurgent in inflation in order for the Fed to not cut rates, but actually to start getting to a discussion around rate hikes.
Matt, how do you feel? That we need more data in terms of inflation to get comfortable to put more risk at play? Or do you find areas now that you can double down?
Yeah, I would say we're more in the latter case. I mean, we think that leveraged loans are a nice place to be. Total returns, we think, for the rest of the year in kind of the mid 6% range. And again, that's just for the next 9 months. But high grade and high yield as well. We have a forecast ultimately that inflation does come down. As the Fed has said, it may be bumpy, but we think the next 3 to 4 months provide a nice window for continued disinflation. And that means even in high grade and high yield, we're looking for returns for the rest of the year, close to, call it 4.5% to 5.5%. So we like single Bs within the leveraged loan market. We still like triple Cs in high yield, and it still feels to us like this cycle still has a little bit more room to run. And client positioning, I would say, is slightly overweight, but it's not excessive. People are not, I would say, complacent or very aggressively long of risk. And so we think that this is the right time to incrementally add a little bit more risk into those higher beta sectors of the market.
I'd be interested in you to answer some of Meghan's concerns here, too, about the risks on the horizon. When you read the inflation data moving forward, Matt, how do you feel about where things could start to change your mind about taking more risk?
Yeah, I think Meghan's spot on with no landing, so to speak. The challenge in that environment, I think, is the market really going to get concerned if the Fed ultimately, in terms of market pricing, goes from pricing 3 cuts this year, let's say, back to 1. And we've already priced out, 3+ cuts earlier in the year, and credit was resilient. And I think the reason for that is growth held up, right? And so in a no landing scenario, I think, we certainly assume that growth holds up, meaning earnings growth and economic growth. And so I think it's going to take some time for that to translate into the Fed messaging, not just that we're not going to cut, but that we may need to start hiking again. And it's that point that I think is the salient one. If the market has to worry about another Fed hiking cycle, I think you will see credit spreads underperform. But the way that we've modeled that is we just think OER and some of the goods disinflation continues to come in the next couple of months. Then you've obviously running into the second half of the year, have the election. And so I don't think the Fed really has time to shift that dramatically and the markets start to ask, are we actually going to have another hiking cycle until the very end of the year, after the election, or maybe even in early 2025. And that's why I say we think it's a nice time in the next quarter or two, to add risk. Away from that, we're certainly watching profits in the upcoming earnings season, but I think the growth data means that nominal earnings growth is going to hold up quite well. Mm-hmm. The other thing I would say is systemic risk. But again, we're not seeing a lot of signs of cracks in areas like lower rated corporate credit, CRE, or even consumer credit.
Meghan, when you think about what's on the horizon here, how important is it to see some deleveraging happening? Because even if you don't see a rate hike, this idea that rates might stay a little higher for longer here will start to feel more of a bite when companies start to refinance.
You're exactly right, Sonali. So I think so far we have seen leverage actually move lower in the high yield market. So updating our fundamental database last quarter, we saw leverage move lower than the long-term median, which tells you that the cost of capital, this elevated cost of capital, is already having an impact. For high yield, though, we're about halfway through the maturities that we expect have to get refinanced this year, and that's a lot of progress already. So I think to Matt's point, the refinancing risk to really come back into the picture is going to be later in the year if we don't get those rate cuts, and then you have next year's maturities that will have to be addressed, and investors will start focusing on it then. But I think for now, the risks around maturities and the rising cost of capital is still pretty muted given all the progress that we've made.
Risks on the horizon, but still quite far away. Meghan, Robson, and Matt Mish, thank you so much for your time. Still ahead, the final spread. The week ahead is a busy one. The latest inflation print is in focus. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead coming up. Monday, it's a North American solar eclipse, and of course, the Fed's Neil Kashkari speaks. He really set the warning shot. This week, we have delivery data from Boeing, and Yellen's visit to China ends. And of course, Wednesday, big day, FOMC minutes and an inflation print. And Thursday, we have an ECB decision and PPI. Wall Street earnings start on Friday, and more Fed speak. But before that, before I let you go, let's talk a little bit about that inflation data and what the expectations are, because the expectation month over month is 0.3%, and same goes for core CPI. Year over year, it's expected to come in at 3.5%, which is of course higher than the prior. We'll keep an eye on all of that for you next week and how it jives with the data we've seen this week. Of course, a lot of moves in yields. We'll be watching it all for you next week as well. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.